Hi, everyone. This is Chris Reyes at BWM Financial. Thanks for joining us today for our market commentary webinar. Jeff's going to start presenting in just a moment, and we expect the presentation to take about 30 minutes. As a reminder, everyone is muted as they join the webinar, but please feel free to ask questions using the chat feature at the bottom of your screen. We'll stop throughout the presentation to answer questions, and we'll have a dedicated Q&A at the end of the presentation. As always, we are recording the webinar, and the replay and slides will be on our website, bwmfinancial.com. And with that, I will turn it over to our president, Jeff Brown.
Chris, thank you very much. Excuse me. So we would like to title things appropriately, and I have to thank Tyler Morris from our investment committee, also a partner of the firm, for coming up with the title of this one. We're calling it the Year of Reversals, with a question mark, to see if that actually happens, because a lot of things are at some level of extremes, and we want to discuss the possibility of those types of things reversing and what might be good for markets and what might be bad for markets, and just what might be interesting in general. As Chris noted, and you see on the slide here, we have changed the name of the firm to BWM Financial from Brown Wealth Management to sort of broaden out it, not to make it all about me moving forward. So I just want to make that noted for people going forward. And as Chris mentioned, please ask questions. He will interrupt me if it's appropriate. I'm not watching the chat or Q&A, but he'll interrupt me if it's relevant, and if we miss it, we'll pick it up at the end there. So with that said, one extreme here recently, you can't get away from it these days, is COVID. I'd focus on the bottom here, not the top, but it's the number of U.S. COVID cases as of the beginning of this year. Omicron is, definitely spreading very rapidly across the globe. I'd say this is the first time in the spikes that we've had where I know a lot of people, where it's almost more people have had COVID than hasn't had it. And you can see, there's this massive move, and hopefully, as like other expansions we've had in COVID, that we are going to see a big reversal off the highs. But while we don't consider ourselves to be scientists here, a lot of things that we've been reading and the data that's been presented has been because this strain is more moderate and more contagious. It doesn't mean we have to not worry about it, but could this be the reversal of the pandemic and moving more into an endemic? And if that's the case, I think this could be a big step forward in terms of moving past this. Now, granted, it might take some time. If you look where those cases are right now, hospitals still getting constrained, not because it's more deadly, just because the sheer number of people is so much bigger than before. But if we can get back to a more normal way of life, I think that's going to alleviate some of the pressures and some of the other extremes that I'm going to cover in the webinar here. So fingers crossed that this could perhaps be a shift in the game against COVID. One of the big things that has been challenged as COVID is the supply chain constraints. It's actually become a joke almost between people that are in my industry about blaming everything on supply constraints, on whether it's delays in your furniture, people not getting their supplies on time, increase in prices, etc. So a good way that I want to look at this is the chart that you're looking at on the right is what they call the global PMI suppliers delivery times. PMI is a Purchasing Managers Index. It's a survey that's done all the time. And here they look at a lot of different things. Here it's how long it takes to deliver something. And the number 50 means it's average delivery time. Below 50 means it's a much longer delivery time, and above 50 means things are moving pretty quick. You could see with the recent reading, it's actually lower than it was at the depths of when the world was shut down during COVID. But you can also see that it's rebounded a little bit. Now, it still hasn't even rebounded to the fact of the lows where it was in 2020. But we look at the trends here more than anything else. So in terms of this reversal, on the bottom clip, we can see the share of those times, the share of delivery times indexing posting positive changes, therefore improving, is 61%. Now that's a pretty good number. That means the bulk of these are improving, not falling apart. And I think this could bode well for, in terms of getting your stuff on time, but also relieving some of the inflation pressures that have been out there as well. Because obviously, people that have studied typical Econ 101, right? When there is no supply and there is high demand, which is sort of what has occurred here, you are going to have price increases that happen. Leading into inflation, we have seen some extremes. This is the core PCE inflation index. This is the Federal Reserve's preferred measure. There is, CPI indexes, this is all different numbers. In fact, there was a CPI index that came out today, big headline number, 7% year-over-year increase. That includes, commodities and such. And once again, looking from a year ago when prices were lower, it is a big increase. Nonetheless, the number we're seeing today, 3.62, which was, I think we're getting an update on this. I just put this together over the weekend in terms of the updated slides. We will have this number here shortly. 3.6% is still very high. This goes all the way back to 2000. You can keep on going back further than that and see that we haven't had inflation this high in a long time. The question is, the Fed was calling this transitory, which means it's going to pass. They've actually changed that language more recently to remove the transitory, and I think that's applicable. I think that it's not transitory. I think that you're not going to have, barring any major event, a lot of this stuff is going to be sticky. Once people pass on price increases, they tend to stay for the most part. Not everything, not some of what I talked about earlier in terms of supply chain, but typically prices get pushed up on your iPhone. They don't go down again. So I think this is going to be one to watch. We have not seen this rollover. You can see where this chart is here. And I know that the next number is only going to be higher based on when they measure it from the year before. But the best way to look at this, I think, is to look where common inflation expectations lie. This is long-term inflation expectations. This is market-based inflation expectations. This is what the market thinks. And rather than trying to predict where things go, which is where most people end up sliding into, right? I predict inflation is going to move up, therefore I do this. We want to always, here at BWM, we listen to the weight of the evidence. And common inflation expectations have moved up. In fact, the Fed has been trying to target 2 to 2.5% long-term inflation, and we have not been able to hold that for a long period of time. However, if we see inflation expectations rise to that middle of that equation, I think it means we can stick there a little longer. And I believe, as I'll get to in a moment, that the Federal Reserve holds the key to this year in terms of 2022. And so as long as inflation expectations can remain grounded, right, not moving too far above that 2.25, maybe a little higher than that, I think we're in okay shape here. I think that it's a lot easier to fight inflation than it is to fight deflation, because the Fed has been trying to fight deflation for a long time and they have not been super successful at that. So I think if inflation were to roll over and that reversal were to come, that is going to be good for the financial markets. If inflation does not roll over, it's stickier than anticipated and it keeps increasing, or it stays at the current rate, that is going to be extremely problematic for the financial markets. And we're going to see that happen in inflation expectations beginning to rise. That's what we're looking at here. So this is a tough one, job openings. I'm not talking about the unemployment rate. In fact, the unemployment rate is below 4% now. And based on how the government measures it, based on the last report that came out in early January. I think what's been a problem here is the record number of job openings. I think that is a problem. I think that is not a good thing to have such a large number of job openings. The reason being is this is looking at the job openings. It's the highest it's been. This goes back to 2000. It's the highest it's ever been. And well, it was the more recent, in that recent peak. When you have such a large number of job openings, that means that companies cannot fulfill what they need to operate. Now, this could be attributed to a lot of things. Some people pointed it out to the large number of unemployment insurance and how long that lasted for. But that's beginning to dissipate, and this really hasn't made a big dent on that. Some of it called it, related to the great resignation, where people have either had enough money built up from the stimulus that they got, or decided that they didn't want to leave, they left the workforce earlier in terms of an earlier retirement, or they recontemplated life based on COVID, and more things were important than for now. Whatever it is, it's the real deal, because you need to go no further than try to get an Uber, go to a restaurant, call a call center, or do what I did over the last week. And I went up to Park City, Utah. There was not enough lifties and there was not enough people to groom the runs to open the resort, even though we had one of the best starts to the season as possible. So this is a real deal. I think having a record number of openings, I think that this coming down is actually going to be a good thing. And you do see a bit of a rolling over there, because as this comes down, that means that people are fulfilling those jobs. That means companies are getting the types of employment that they need to fuel the growth that ultimately helps the economy move in the right direction. Now, here's a couple negative ones, right? The first off is we had a big boom after COVID. What you're looking at on the bottom is what I want to focus on, is the recession probability model. It's a global recession probability model. And that's the way that Ned Davis, our research facilitator, puts it. I would call it a slowdown probability model, okay? Because there's actually hasn't been that many global quote unquote recessions where everything has declined. But you saw this increase recently pretty rapidly. And I think this is the result of Omicron kind of shutting things down and messing up the system again here in a pretty rapid way. And you're also comparing growth. You know, it slows down because growth was pretty rapid last year. So growth year over year is going to be lower. What we don't want to do is see this move over that 70 number, which means there's a high probability for a worldwide global slowdown. And the timing of this is a little unique, because I'm going to talk about in a moment what the Fed is doing. The last time that we moved into above the 70 mark was in 2018 and into 2019, right? And at that point in time, we were slowing down, yet the Fed was raising interest rates. I mean, they were doing it fairly aggressively back then to try to get back to a more normal process. And I think that if that same combination occurs, where we have a slowdown occurring and the Fed's trying to get back to normal, that spells volatility for the market, because at the end of 2018, there was a pretty good sized correction in the market as a result of these two things moving together. Now, fortunately, this is an example of where our objective indicators do help, where we would see, okay, we have global growth slowing and the Fed is raising rates. We don't want to fight the Fed. So we actually were able to get underweight equities for that particular event. But nonetheless, that wouldn't be good for financial markets should that combination occur again. So speaking of the Fed, this I think is the key to 2022. The Fed has got to thread the needle. You're looking on the top is the total reserve bank credits. The way I like to look at, you know, how much does the Fed have on their balance sheet? The bottom chart shows how that's broken down across various pieces, but this shows we're at a record. And as people that have been paying attention to either other webinars or the news know, that the Federal Reserve that has been buying bonds, which is why this has been increasing. It had the big rise in after COVID, during COVID, and it's been going on steadily because they've been buying bonds. They've decided to taper those bond purchases, and that means they're going to be buying fewer. That doesn't mean they're not buying any, it means they're buying fewer. And as they move into next year, they're looking to stop buying bonds, and then they would historically let them reinvest, and then after that, they let the bonds wind off the balance sheet, or the balance sheet reduces, which is what you can see on this line here, which is what occurred basically from 2018 until more or less till we had the COVID resurgence occur. So that is money that is no longer being pumped into the economy. And as the balance sheet winds down, so it's going to go flat for a while, and as it winds down, that is actually money that is being drained from the economy. So that is something to definitely watch. So this is a reversal. It's nice to have all this cheap money, but what does it do to the markets if it starts getting removed? And if it gets removed quickly, that is going to be the question to watch, or the question to have answered. Interest rates is the second phase of what the Federal Reserve is going to do. So they will, unless something changes, they have telegraphed they're going to raise interest rates next year. Now, rates are zero, so they can only go higher from here for the most part, unless we go negative interest rates, which luckily hasn't happened yet. And if I want to focus here on this bottom chart, and it's very confusing if you try to figure it out. What it's using is OIS swaps to see what the market thinks the Federal Reserve is going to do with interest rates. And what it is, I'll highlight this orange line, which looks at where rates are today and where rates are supposed to be 1 year from now, and they take the 1 year minus the current rate. What's the difference? It's 1%. Typically, the Federal Reserve raises 25 basis points each time. So this would be marked to saying the Fed is going to raise rates 4 times over the next 12 months. The Fed has sort of telegraphed that they're going to do this 3 times, and you can see this thing moved up pretty quickly recently based on the minutes of the last Federal Reserve meeting that they had. So we went from 3 to 4 times pretty quick. So they are looking to raise rates, at least the market thinks, 4 times over the next 12 months. Now, I'll talk a bit about like timing of that. I don't think that's the end of the world, right? 1% Federal Reserve, that does not spell grandiose interest rates across the board here. It's no longer, sub 3% mortgages. In fact, you can't get 3% mortgages anymore for the most part, unless you're looking some shorter term. So we've already kind of moved past the easy, cheap money, but this isn't restrictive by any means. Interestingly, on top of this, if we look at where rates are supposed to be 3 years from now, so the way it goes is 1 year minus current, 2 years minus 1 year, 3 year minus 2. More or less, they're looking at, if you look at 2 years out, it's supposed to be 0.5%. That's that black line higher. So 0.5% higher than that. So that's a 1.5% Federal Reserve rate. And then 3 years out, it's saying it's not really even going to move there. If this were to hold true, and this is guaranteed to happen, this would mean that rates are going to remain low for a long time. So if this starts moving much quicker than that, that means the Fed's going to take their foot off the gas much quicker, and then eventually apply the brakes. And that would be, once again, it's, as I'm going to show you in a moment, it may not be so much how much they move, but the speed at which they move. And that's what's showing here. This takes a look at all the different cycles of Federal Reserve movements. All cycles is in the blue line. Where they have hiked interest rates slowly is the black line, and where they have hiked interest rates quickly is the orange line, okay? And where they haven't hiked rates at all is the green line. That makes sense because the green line would be the best. That includes when they've cut interest rates. So obviously when they're cutting rates or not doing anything, economic growth happens quicker. When rates, the Fed, when they raise rates, what they're trying to do is they're trying to get back to normal or slow things down, slowing inflation and things down, like I mentioned earlier. So if we look at 1 year out, so what I just highlighted is 12 months after the first interest rate hike, you could see that the slow tightening cycle, or the black line, and non-tightening cycles are almost identical. Okay, so slow hikes, right? That'd be maybe a 1/4 point every couple of months, right? I think if they did 4 hikes in the total of 12 months, that would be a slow interest rate cycle. That would still be good for markets. That's a 12% move from where the first hike was. Now, if they went faster than that, if inflation doesn't roll over or something else comes up and they got to take more action, fast cycles is almost the opposite. It isn't down 12, but it's down about 2.5%. So it's a pretty big difference. That's a call it 12% differential in terms of how fast they move. Once again, getting back to the fact that you don't want to fight the Fed. If they're going to aggressively hike interest rates, you do not want to be overweight equities. But also on the flip side of that, you don't want to try to predict what they're going to do until they actually begin doing it. And we look at some of these indicators that I have before and seeing where the market thinks they're going to go. Another extreme, earnings growth. It has been remarkable. Corporate America has it's astounded me how much we've moved from where we were even prior to the pandemic to where we are today to where we're expected to be at the end of this year. Right now, if we look at where earnings are supposed to be at the end of next year, it is an all-time high. And that dotted line that I highlighted, that yellow dotted line, you can see that going up. You can also see the line below that going up as well, which was after a big COVID, we've had increases. But if you look to the left of that, for the most part, those dotted lines tend to follow a downward trajectory. How does this come up? Well, this is the combination of every analyst out there putting their expectation together for every equity that's out there, and that being rolled up into every equity in the S&P, and that being rolled up into the S&P number. So generally, analysts are too optimistic. When the market performs pretty well, however, is when they're not optimistic enough and things exceed expectations. So the question is will we have a transition from this all-time high in earnings, and will this begin to roll over? Therefore, sort of reducing future earnings expectations, therefore potentially affecting valuations in the market. Next up, valuations. Now, valuations here, what you're looking at on the bottom is it's the price to earnings ratio on the S&P 500. So it's historical, it's looking backwards. For those of you that don't know what price to earnings ratio is, it's how much the market is trading at relative to the earnings that it makes. The higher the number means it's more expensive. You own a dry cleaning business, you make $100,000 a year. It's trading at 10 times earnings, it's worth $1 million. If it's trading at 20 times earnings, it's worth $2 million. Like, you'd want to buy it for $1 million instead of $2 million if you could, because you're going to get your money back faster. So we were at record valuations. Never been seen before on the S&P, sort of in the COVID year. Why? Well, because you had a tremendous amount of stimulus that propped the stock market back up, but earnings were not there. And you can see where I'm highlighting here is that this extreme, the reversal has already begun to happen off of this extreme. And fortunately, for the most part, this has been driven by not a decrease in the price, but an increase in the earnings. The best thing that could happen here is the market will grow the rate less than the earnings growth. So if on the chart that I showed you before, if we just maintain a normal growth rate this year, then this will continue to decline if we hit those earnings estimates. Earnings can be high. The valuations can be high when interest rates are lower. It has to do with discounted of cash flows. I'm not going to get into that here, but you can just trust me that rates lower equals higher valuation. If rates were to move up quickly equals lower valuation, that would cause this to decline. Probably not likely because of increased earnings, but for the reason we probably wouldn't want it to decline, which is a decrease in prices. So I do believe that our valuation extreme will be reversed even more. The question is, what's going to cause it over the next year? Is it going to be a decline in the prices, or is it going to be an increase in the earnings relative to the price gain? And you know what? It's not just the stock market. Money has fueled its way into everything. I was talking to our director of wealth planning, Chris Pegg, today about real estate just now, and he and Robert from our team were having a conversation outside my door just about, I can't believe how expensive real estate is. And we can look in that middle chart here, looking at how much the home price index is, and this kind of looks at the trend line, is that dotted line, and we keep a trend line going up because of inflation, right? There's a certain trend that it should be there. Historically, that's been where housing is appreciated, and we've had these big booms. Like, you can look to the left and see the last boom, and unfortunately, that went down because of prices. So we're at this peak, and the question is, will this reverse? The data that we have says it may not reverse so much like it did before, but it may at the minimum stall. We've had that conversation on webinars here in the past. We've been having it with clients. So we think, for the aggressive person out there, I don't think it makes sense to be jumping into residential real estate for a great return on your money moving forward, at least relative to some other assets. Doesn't mean you're going to get hurt necessarily. It just means that I think we've pulled a lot of future returns on real estate into the present as people have focused more on living at home and how it means after spending so much time there. B, the fact there's not enough new supply being built, although that is changing. I mentioned that in previous webinars, how supply is increasing. And then just demographics, as millennials have moved out, they're buying their homes now. And if we can't, and there's more people in that age demographic. So all of that is positive along with low interest rates. What could cause it to change? Interest rates increasing. I already said the Fed's going to raise rates. That probably means rates are going to go up on housing. B, more supply. When people become confident saying, wait a second, I just made 25% on my house price over the past 12 months, and I don't need to live in this type of house anymore. I want to be more flexible. I want to downsize. I have 3 homes and I'm going to go to 1. More supply in the market, a combination of interest rate increases, that could put pressure on this. But we're not suspecting a big housing market debacle like we had in the financial crisis, because there's a lot of equity in houses and there's just not as much supply as there needs to be presently. But I do think that this price, the way that slope is going, is just not sustainable where we are today. And then another thing is looking at international equities. So this is another extreme. If we look at the top chart, this top chart shows how well the world index outside the United States has performed relative to the S&P 500. A downward line means that the world index has underperformed the S&P 500 a lot since the financial crisis. In fact, owning international equities, while it has provided diversification benefits, owning the S&P 500 looking back just would have been better. Higher volatility, higher valuations, but nonetheless a better call. We were overweight, and what those arrows are, that's an indicator that we actually developed here at Brown Wealth Management to try to identify when it made sense to go over and underweight equities. Back in 2016 to about 18, we went overweight equities on our signal, and it did fairly well versus the international versus US. Recently, we've actually had a bit of a signal on this. So this is something that we have been carefully watching, although we haven't really had there's been other things we need to line up with this in order to go overweight international. The valuations, which I'm not showing here, are dramatic differences in valuation, dramatic differences in the sector makeup of these. You've had these large stocks like Apple that have grown so much, trillions of dollars, but you look at Apple's worth so many different companies in the United States, right? So at some point, too big is too big, and you just can't get the same returns as you can in smaller companies. So I'm not saying we're making a change yet, but is this a potential reversal in the making? I think it was worth bringing up, because when things get extreme like this, it usually means it's like a rubber band being pulled so far that we might have some level of return to the mean. And then finally, people label it as cryptocurrency, Bitcoin, Dogecoin, whatever you want to call it. I'm putting up Bitcoin here. We never addressed these on the webinar before, but I think it is time to address digital assets. We were actually in some ways prohibited from talking about these types of assets due to regulations and just a lack of knowledge in our industry. Personally, I'm certified in digital assets as of presently. I took a course in it, and you'll be seeing more coming out of BWM, not just on an opinion on digital assets and what we think of it and some educational materials, but also how we would recommend investing for those people that want to, whether or not we recommend it in terms of a strategy or not. But I think it was worth putting up Bitcoin here for the reason that, the way, just a quick synopsis of how Bitcoin works is that you get rewarded Bitcoin from mining. So that's what keeps Bitcoin going into circulation. There's roughly 18 million Bitcoin out there. There's going to be a maximum of 21 million. Forget about the stuff that's got lost there. But when you're mining, and that's what all of that mining is, it's the authentication of the transactions that occur on the blockchain. Too much information for this here, but you just trust me. But what is interesting is the way it works is that every roughly 4 years, the amount of Bitcoin they give away gets halved. Okay, so it gets cut in half in terms of what you get rewarded for that verification process. What's interesting is there has been a trend here that roughly after the halving occurs, which is those dotted lines, roughly about a year or so after is when you see these peaks in the price. Now, we've seen Bitcoin be pretty volatile this year. We saw some very high prices. It went back and it came down, but we're right about that same stage as we are today. So the question is, might we see a reversal in digital asset prices like Bitcoin, specifically Bitcoin here, as we kind of follow trends of the past? More to come in roughly later part of this quarter with a special webinar on digital assets, cryptocurrencies, and such. So time to kind of review. We already talked about the Federal Reserve. We talked about they're still positive, although they're going to be changing, but I would not call them negative by any means today. So I'd still give the Fed a thumbs up. They're still pumping money into the economy for the time being with zero interest rates. Currently, our sentiment, beware the crowded extremes, rule true, we're in the neutral zone here. So we dipped into pessimism recently. So this is an average score. And then in terms of the trend, it's still positive. It's deteriorated. We're still into that bullish zone, although we have definitely not dropped into where we would see our sell signals here, but we have seen some level of deterioration. And I think so what that means for us is that all of our indicators that I talked about still line up to be overweight stocks. We're still overweight equities and underweight bonds and really neutral on cash. And I would call it, we'd probably be underweight cash and have more in short-term bonds. The key is that we're overweight equities and we still maintain that's the place to be. And we're still in the United States large cap segment. We've been that way for well over a year and change. Since COVID hit, we started buying in that space. And that continues to, for at least the longer duration, that's been the outperformer. We did it through the equal weight S&P 500. That still continues to look the most attractive to us. And as I said multiple times, we have a tight leash on that. If we see deterioration, especially now that we've entered a new tax year, we are very quick to cut that overweight to neutral and then get defensive if we need to. In terms of bonds, we're sort of overweight in credit, which means we own things like mortgages and such rather than government bonds. And we are more underweight, which in terms of duration, which means we own shorter term versus longer term bonds. So the bottom line, I'm right at time here. So bottom line is the potentials reversals that would be positive for the markets. So the reversals that are good would be a change in the COVID landscape, supply chain moderation, and a slowing of the rate of inflation. Reversals that could be negative are that slowing economic growth or slowing earnings growth, and most importantly, the restrictive Fed. Valuation adjustments obviously would be negative because that would be prices going down, right? So I think, as I mentioned before, the Fed holds the key to 2022, barring something I don't know about currently or we don't know about. But I do think that future asset price appreciation across most asset classes is just going to be lower than it's been in previous years. We've had 3 really good years in stocks, real estate, and alternatives. We're going to be leaning more on that third category, things like alternatives, which can, we talk about on an individual level with clients as we kind of move forward here. So that can be fixed. Future price appreciation could be higher if we had a big correction, obviously. We don't want that necessarily. We can't control that. So I just want people to maintain the fact that, hey, what is back to normal, right? Most average 60-40 portfolios are going to generate a 6 to 7% rate of return. That is normal, not what we had over the past couple of years. And especially assets that have outperformed. I think that, it's still outperforming is still continuing to happen. We do think that there's likely to be some level of rotation. And as I mentioned before, we're still overweight equities relative to bonds and cash. So I know I'm 2 minutes over here. Here's my disclaimers. So you can unmute your line. I'll let Chris start with any questions that have come through, and then we'll open it up to other questions. And obviously, we're right at that 12:30 mark, so this will be recorded, so you can catch the answers later if you need to. And thanks for attending if you have to leave.
Yeah, Jeff, we have a few questions rolling in here. The first one is about inflation. And the question is, what inflation rate does BWM use for our wealth management reviews and financial planning purposes?
Yeah, that's a really good question. I have that because that came in ahead of time. So currently, we are using the inflation rate that is built into our financial planning softwares that we use is 2.33%. Okay, so that's projecting from this point going forward. Okay, and some might say that's low relative to what you saw on the screen, but let's bring it back to the inflation expectations, right? That's still actually lower than the inflation expectations are. So the other thing to note is that anything, so for people that say, oh, wait, I'm not counting that, we've paid more for this or that, but as for people that are our clients that are going through wealth management reviews that now have to pay more money for the things that they, because inflation is higher, that's why we do these reviews. We view ourselves as guides on a mission rather than defenders of a financial plan. The numbers in the financial plan are wrong the day after, perhaps the day of, that we created. Markets change, life changes. So what we use is just a roadmap to guide on. So it isn't how detailed those numbers are that matter most. It matters sort of the big picture. So the constant review of things is what matters the most. And then just an aside here, we are actually going to be we are beta testing a software for clients that are interested, where we will be able to track sort of what a client can spend in a given portfolio value based on their financial plan, and what would cause them to make a change in the spending in terms of a valuation adjustment. So seeing, hey, you're spending $10,000 a month, but if your portfolio dropped by 24%, we're going to adjust it to $9,500. So it's something we're testing out. If you do have we will be rolling it out onto selected clients to test out this year. If you're interested in beta testing this, please reach out to me or your financial advisor. We can put you on a wait list. It's a different way of looking at things rather than the probability of success. The probability of success that gets talked about in financial planning is if people get, I think this has kind of changed in the world a little bit. It's like people think I look at like an airplane. What's the probability of success of it landing? If it came in at like 90%, that's not great. That's not what our financial planning software does. It's the probability of having to make a change. So getting back to if you have a 90% chance, it's a 10% that it's going to have to make a change. So every plane that takes off has a flight plan. Almost everyone has a high probability of making a change to that flight plan. That's what financial planning is all about. And what would that change look like? And is it going to be significant enough to change the lifestyle? So sorry for the digression there, but I wanted to cover it because that's one of those things that you can't get quite right, but we will update it as time goes on.
Got a few other questions here about the recent market volatility we've seen. Are we concerned about a correction?
Yeah, let's see. So we are not concerned about a correction. I would say that clients obviously don't like corrections. Corrections are not great, right? No one likes to see. If you're like me, I like to look at my account balances when I know things are up. When they're down, I don't really like to look at them as much, right? So it's just kind of the way I think human nature works. This is a great slide for that. I had this pegged here. I was going to actually include this in the webinar. What this is the number of days in the middle. So we've had a 5% correction in the, so second clip down, 5% correction. Clip after that, 10% correction in the S&P, and the number of days to a 20% correction in the S&P. We've been about 64 days to a 5% correction. That's about average, maybe a little shorter. We had it not that long ago. I want to focus on that 10% correction. We've been about 451 days since a 10% correction. You typically have a 10% correction every year. We're 451 trading days, not calendar days. So we are due for a 10% correction. That is part of signing up for equities, right? That is the deal. It could happen tomorrow, and it's no big deal on our, will it cause us to change our asset allocation? Absolutely not, unless our indicators changed, okay? It could be a buying opportunity. It could be a reason to take money off the table. It all depends on what's causing it and what's happening under the scenes. And obviously the 20% correction is also 451 days. They both happened at the same time. And we haven't had a big one since that 2020 COVID correction. So I would not be concerned if we got a 10% correction. Obviously a 20% correction affects people more. I don't put that in the cards for this year unless the Federal Reserve moves much more than the market thinks it has to, or something comes out of left field that we just don't know about. So I'm not concerned. If it did and we had some deterioration, like I mentioned, tight leash on the overweight, we'll cut that exposure and we'll see where to go from there.
Thanks, Jeff. A few more questions here. Are there any possible pending legislative policies other than Fed policy that may change our outlook?
I wish Chris Pegg was on the call. I'd have him answer this now, but I don't think anything. I think right now, the large stimulus bill that was being proposed by the Democrats looks somewhat dead in the water. Okay, if that were to happen, that's more money entering the economy on the short term potentially, but the infrastructure and such associated with that is over a long period of time. So you might get more fiscal help from that. I don't think a change in the capital gains rate, at least what was discussed before, has any negative impact on the markets. Might have on some people and strategies and all of that, but not on the markets. I don't see anything that we currently are looking at from a legislation standpoint that Chris Pegg and his team's looking at as being really affecting to the financial markets currently.
Thanks, Jeff. We have another question. How much cash is on the sidelines, and what has been the flow of investable cash into fixed income and equities?
So amount of cash on the sidelines is very low in our portfolios. We're holding like about 1% as we have been. We are holding a fairly reasonable amount. And you actually might be the one to answer like how much we might have in short duration on like a traditional 60%. What's the rough guess there, Chris?
You're putting me on the spot, and I don't have that number off the top of my head.
Okay. I think it's about, calling a 60% portfolio, close to like, I guess like 7 or 8%. You can maybe confirm that. But we've tried to keep the amount of, because we're overweight stocks, we don't want to have a lot of cash on the sidelines, right? We want to have a lot of cash on the sidelines when we're underweight equities. So currently we are overweight. And in terms of the investing that we've done, almost all the changes that we've made in recent times have been more like under the hood changes. And that I don't know if I'm answering the question directly here, but like some changes in the fixed income duration has been one of them. Some changes in the investing in developed over emerging market equities. So, but for the most part, we are not holding a lot of cash because it hasn't been productive. But as mentioned, when it is, that's, we don't want to hold cash when things are going the right direction. We want to hold cash when we think things are going to go the other way, and we're not in that situation as of January 12th, today.
We actually got a clarification on that question. The question was about for market participants, how much cash does the market have on the sidelines, so to speak?
Yeah, it's a low. I don't have that figure in front of me. It would take me some time to do that. So maybe you can, if you have the person, I can get back to them after that. There's
Sure.
a lot of dollars on the sidelines. Okay, so it's somewhat like a lot of dollars. The challenge is the market's worth a lot. So we're looking at in terms of the percentage of investable assets. So the percentage is low, even though the dollar figure is high. I don't know either one of those today, but so you might have much more in total dollar terms than you had, when things were doing poorly, but because the market has expanded so much, it's a lower percentage, if that makes sense. So the analogy might be, if you had a $250,000 mortgage on a $1 million property, it's 25%, right? Well, the property then goes to $2 million and now it's 12.5%. So it's the same dollar figure, but the percentage is lower, and that's kind of where we're at. It's a low percentage now. So I know they say, you watch CNBC and such, they say all this cash on the sidelines, as a percentage of all investable assets, it's actually a pretty low number today.
Got one more question here regarding job openings. This person says, clearly there was an uptick about 6 months or so into COVID, but job openings were trending up and tripling, almost quadrupling over the 10 years from the 2009 recession. Is there something else going on besides?
Hello?
Did I cut out?
Yeah, you did. Something else going besides what?
Is there something else going on besides people reassessing after COVID?
Yeah, hold on. Getting back to the chart here. Yep. So looking at the chart, I think this is what they were referring to. So it went from, roughly what, 5 million job openings prior to the financial crisis, and then it got up to, actually got up to 7 million. I think that's the result of the economy. The economy was like from 2016, the economic growth was pretty decent. And so you saw an uptick there. But what's going on for the most part was this combination of people, the labor force participation. So people participating in the labor force just didn't reassert itself after the financial crisis for a variety of reasons. But it just didn't reassert it. Like a lot of people retired earlier and didn't come back to the workforce. And then there was a generation, the millennials we'll call it, that after the financial crisis and then short thereafter, stayed in college longer, got other degrees. We're looking at doing other things. So you didn't have this the traditional uptick that happens. And a lot of, I'd throw even teenagers in this category as well. Is that, like when, and this is like, I'll date myself too much, but it was always expected that teenagers worked and got jobs. That isn't the case as much anymore in America, as many of them, not saying all of our clients, but as people just in general focus more on education. So the pool of people working is smaller. The other thing that's big here, without jumping on the political landmine, that also something that happened after 2016 was a big change in immigration. So we had a lot, we have a lot of people coming to this country, and the process of getting into the country and getting approved to work here, that has gotten much more restrictive in terms of visas and such. And I think that also has played a big impact in terms of the ability to have the people required to fill the jobs that are out there.
That was the last question that's come in. If you have a question, feel free to throw it in the Q&A or email us after the webinar.
All right. Excellent. Well, I'm sorry I went a little over today. I tried to take some extra time to explain the slides, more so than before, getting feedback from clients in previous webinars. So we might just extend the time frame to about 45 minutes, or I'll cut some slides out. If anybody does have feedback associated with which one of those you would prefer, let me know. And any other feedback would be appreciated. Not just questions and stuff, but the ways we could make this better going forward. I always get the general that it's a little confusing on the charts and tend to move fast. The charts are the charts. That's what I look at every day. But anything else you can help us get better on, I'm here to listen. As always, we appreciate your trust and confidence, and Happy New Year to everybody.